Listen, what I'm about to tell you is going to completely change how you think about money, and it's happening right now, as we speak. While most people are scrolling through their phones completely oblivious, one of the biggest financial shifts in human history is unfolding, and China is at the absolute center of it. If you think this doesn't affect you, think again, because what's happening in Beijing right now could determine whether your savings are worth anything in 5 years. So before we dive deep into this rabbit hole, smash that like button and subscribe, because you need to understand what's coming. Right now, something extraordinary is happening with gold. The price of gold has been climbing higher and higher, breaking records that nobody thought possible just a few years ago. We're talking about gold hitting levels that have investors, central banks, and governments around the world scrambling to figure out what this means. But here's what most people don't realize. This isn't just about gold becoming more valuable. This is about the US dollar becoming less trustworthy, and China has been watching, waiting, and preparing for exactly this moment. For decades, the US dollar has been the undisputed king of global finance. If you wanted to buy oil, you used dollars. If you wanted to trade internationally, you used dollars. If you wanted to store wealth, you held dollars. The entire global economy was built on the foundation that the US dollar was as good as gold, maybe even better. But that foundation is starting to crack, and the cracks are getting bigger every single day. Let me paint you a picture of what's been happening. The United States government has been printing money like there's no tomorrow. We're not talking about a little bit of money printing here and there. We're talking about trillions upon trillions of dollars being created out of thin air. During the COVID pandemic alone, the U.S. printed more money than had printed in the previous 200 years combined. Let that sink in for a moment. 200 years of American history, and we printed more money in just 2 years than all of that time combined. Now, you might be thinking, so what? The government prints money all the time, right? Well, yes, but there are consequences to printing this much money this quickly. When you flood the market with dollars, each individual dollar becomes worth less. It's simple supply and demand. If there are twice as many dollars chasing the same amount of goods and services, then each dollar can only buy half as much. This is what we call inflation, and Americans have been feeling it at the gas pump, at the grocery store, and in their rent payments. But the impact of this money printing doesn't stop at America's borders. Because the dollar is the world's reserve currency, when America prints money, it essentially exports inflation to the entire world. Countries that hold dollars in their reserves, countries that price their commodities in dollars, countries that have taken out loans in dollars, they all get hit by this devaluation. And let me tell you, a lot of countries are getting pretty tired of it. This is where China enters the story in a big way. China has been the world's manufacturing powerhouse for the last 3 decades. They've accumulated massive amounts of US dollars through trade surpluses, selling everything from iPhones to furniture to the rest of the world. At one point, China held over $1 trillion in U.S. Treasury bonds, essentially lending money to the American government. But here's the thing. China's leadership isn't stupid. They've been watching the printing presses run in Washington, and they've been asking themselves a very important question. Why should we keep holding an asset that's being deliberately devalued? This brings us to gold, the ancient store of value that has survived every empire, every currency collapse, and every financial crisis in human history. While the U.S. has been printing dollars, China has been buying gold, and they've been buying a lot of it. According to official reports from the People's Bank of China, they've been increasing their gold reserves month after month for over 2 years straight. But here's where it gets really interesting. Most experts believe that China is buying far more gold than they're officially reporting. Why would China hide how much gold they're buying? Think about it strategically. If the world knew exactly how much gold China was accumulating, it would drive the price up even faster, making it more expensive for them to continue buying. By keeping their true holdings secret, China can accumulate gold at lower prices. Some analysts estimate that China's real gold reserves could be 2 or 3 times higher than what they officially report. We're potentially talking about tens of thousands of tons of gold, worth trillions of dollars. But China isn't just buying gold for the sake of collecting shiny metal. They have a much bigger plan, and this is where things get absolutely fascinating. China wants to challenge the dollar's dominance in global trade, and gold is a key part of their strategy. For years, China has been working on making their currency, the yuan, more internationally accepted. They've set up currency swap agreements with dozens of countries. They've created the Asian Infrastructure Investment Bank as an alternative to Western-dominated financial institutions, and they've been pushing for more international trade to be conducted in yuan rather than dollars. The problem is, nobody really trusts the yuan the way they trust the dollar. The Chinese government controls their currency tightly, manipulating its value to support their economic goals. The yuan isn't freely convertible, and China's financial system lacks the transparency that international investors demand. So, how do you make your currency more trustworthy? You back it with something that everyone trusts: gold. Now, China hasn't officially announced that they're going to back the yuan with gold, but all the signs are pointing in that direction. They've been building the infrastructure for a gold-backed digital currency system. They've been establishing gold trading hubs in Shanghai and other Chinese cities. They've been creating ways for international traders to settle transactions in yuan with gold as the underlying asset. If China were to announce tomorrow that the yuan is backed by gold, it would send shockwaves through the global financial system. Let's think about what this would mean in practical terms. Right now, if you're a country like Saudi Arabia and you want to sell oil, you sell it in dollars because that's what everyone accepts. But what if China, the world's largest oil importer, said, "We'll buy your oil in yuan, and those yuan are backed by gold"? Suddenly, you have a real alternative to the dollar. You could take those yuan, convert them to gold if you wanted, and you wouldn't have to worry about the U.S. Federal Reserve printing away the value of your money. This scenario isn't just theoretical. It's already starting to happen in small ways. China has been negotiating with Russia, Iran, Saudi Arabia, and other major oil producers to conduct trade in yuan. Russia, facing Western sanctions, has been more than happy to accept yuan for its oil and gas. Iran, also under sanctions, has been using yuan to sell its oil to China. Even Saudi Arabia, America's longtime ally in the Middle East, has been in talks with China about accepting yuan for oil sales. The implications of this shift are absolutely massive. The U.S. dollar's status as the world's reserve currency gives America what economists call an exorbitant privilege. It means the U.S. can print money to pay for imports without facing the same consequences other countries would face. It means the U.S. can run enormous budget deficits because there's always demand for dollars and treasury bonds. It means the U.S. can impose sanctions that cut countries off from the global financial system. If the dollar loses its reserve currency status, America would lose all of these advantages. But let's talk about why this is happening right now. Why is this moment particularly significant? Well, several factors are coming together at the same time, creating what China sees as a perfect opportunity. First, as we've discussed, the U.S. has been devaluing the dollar through aggressive money printing. Second, the U.S. has been weaponizing the dollar through sanctions, making countries nervous about relying too heavily on dollar-denominated systems. Third, global debt levels are at all-time highs, and a lot of that debt is denominated in dollars, making debtor nations eager for alternatives. And fourth, Geopolitical tensions between the U.S. and China are at their highest point in decades, giving China extra motivation to reduce their dependence on American financial systems. The timing with gold prices is particularly crucial. Gold recently surpassed $2,700 per ounce, a record high. Some analysts are predicting it could reach $3,000 or even higher in the coming years. When gold prices rise, it's usually a sign that people are losing faith in paper currencies. It's a vote of no confidence in the central banks and governments that control those currencies. And right now, that lack of confidence is being directed primarily at the U.S. dollar. Let me give you some historical context that will help you understand just how significant this moment is. The story of gold and currencies goes back thousands of years, but let's focus on the modern era. After World War II, the global financial system was rebuilt at a conference in Bretton Woods, New Hampshire. The Bretton Woods system, as it came to be known, established the dollar as the world's reserve currency. But here's the critical part. The dollar was backed by gold at a fixed rate of $35 per ounce. Other countries could hold dollars knowing they could exchange them for gold whenever they wanted. This system worked well for a while, but by the 1960s the U.S. was running into problems. The Vietnam War and domestic social programs were expensive, and the U.S. was printing more dollars than it had gold to back them. Countries started to get nervous. France, under President Charles de Gaulle, actually started demanding gold in exchange for its dollar reserves, calling America's bluff. Other countries began to follow suit. On August 15, 1971, President Richard Nixon made a shocking announcement. The U.S. would no longer convert dollars to gold. This became known as the Nixon shock, and it fundamentally changed the global monetary system. Suddenly, the dollar was backed by nothing but the faith and credit of the U.S. government. It became what we call a fiat currency, meaning its value is based on government decree rather than any physical commodity. Many people at the time thought this would be the end of the dollar's dominance. How could a currency backed by nothing maintain its position as the world's reserve currency? But something interesting happened. The U.S. made a deal with Saudi Arabia and other oil-producing nations. They would sell oil exclusively in dollars, and in return, the U.S. would provide military protection and support. This created the petrodollar system, which gave the dollar a new form of backing. You needed dollars to buy oil, and everyone needs oil. The petrodollar system has been incredibly powerful for 50 years now, but it's starting to fray. And China has been studying this history very carefully. They've learned that to challenge the dollar, you need to offer something of fundamental value. In 1971, the U.S. removed gold backing. Now, China is considering adding it back, but for the yuan instead of the dollar. This would be a historical reversal of massive proportions. China isn't the only country stacking gold, by the way. Central banks around the world have been buying gold at rates not seen since the 1960s. Poland, Hungary, Singapore, Turkey, India, and many other countries have been significantly increasing their gold reserves. This is a coordinated global move away from dollar dependence, and China is leading the charge. Let's look at some specific numbers that really drive home the scale of what's happening. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2022, the highest level of annual purchases since 1967. In 2023, they purchased another 1,045 tons. In 2024, the trend continued with purchases exceeding 1,000 tons again. This represents a dramatic shift from the previous decades when central banks were net sellers of gold. China officially reported adding 62 tons of gold to its reserves in 2023 alone, but again, many experts believe the real number is much higher. Russia has been equally aggressive, increasing its gold reserves from around 500 tons in 2008 to over 2,300 tons today. That's more than a 400% increase. Turkey went from around 116 tons to over 550 tons. These aren't random fluctuations. This is a coordinated strategy. Now, let's talk about what this means for ordinary people, because this isn't just some abstract financial theory that only affects bankers and politicians. This affects everyone who uses money, which is all of us. If the dollar loses significant value, Americans will see their purchasing power decline even further. Things that are imported, which is a huge portion of what Americans consume, will become much more expensive. Your savings, if they're held in dollars, will be worth less. Your retirement accounts, unless they're diversified into other assets, will take a hit. For people outside America, the effects could be even more dramatic. Countries that have taken on dollar-denominated debt could find themselves in severe financial distress if the dollar's value becomes unstable. We could see debt crises, currency crises, and economic chaos in emerging markets. On the other hand, countries that have been preparing for this shift by accumulating gold and reducing dollar dependence might find themselves in much stronger positions. Let's dig deeper into how China has been preparing for this moment, because their strategy has been incredibly sophisticated and has been unfolding over many years. It's not like they woke up one morning and decided to challenge the dollar. This has been a carefully planned, methodically executed long-term strategy that goes back at least 20 years. One of the key components of China's strategy has been the Belt and Road Initiative. If you're not familiar with it, the Belt and Road Initiative is China's massive global infrastructure project involving hundreds of billions of dollars in investments across Asia, Africa, Europe, and Latin America. China has been building ports, roads, railways, power plants, and telecommunications networks in countries all around the world. On the surface, this looks like China being generous, helping developing countries build infrastructure. But there's a much deeper strategic purpose. When China builds infrastructure in a country, they typically require that country to take out loans in yuan to pay for the projects. Chinese companies do the construction work, often bringing in Chinese workers. The projects are designed to facilitate trade routes that benefit China. And here's the crucial part. When these countries need to repay their loans, they need to do it in yuan. This creates artificial demand for the yuan and ties these countries into China's financial system rather than the dollar-based system. Let me give you some concrete examples of Belt and Road projects and how they're reshaping global trade. In Pakistan, China invested over $60 billion in the China-Pakistan Economic Corridor, building highways, railways, and energy infrastructure. Pakistan now has to repay these loans in yuan, and much of its trade with China is conducted in yuan. In Kenya, China built a railway from Mombasa to Nairobi at a cost of over $3 billion. Kenya's debt to China has grown substantially, and they're increasingly tied to China's economic orbit. In Greece, China purchased a controlling stake in the port of Piraeus, the largest port in Greece and one of the busiest in Europe. This gives China a strategic foothold in European trade routes. In Djibouti, a tiny country in East Africa, China built its first overseas military base and controls the port infrastructure. Djibouti's debt to China exceeds 80% of its entire GDP. These aren't just infrastructure projects. They're strategic positions in a global game. Some of these Belt and Road projects haven't worked out well for the borrowing countries. Sri Lanka, for example, borrowed heavily from China to build a port in Hambantota. When Sri Lanka couldn't repay the loans, they had to lease the port to China for 99 years. This was a wake-up call for many countries about the risks of Chinese infrastructure loans. Pakistan has taken on so much Chinese debt for Belt and Road projects that it's severely strained their economy, leading to multiple IMF bailouts. Critics call this debt trap diplomacy, but from China's perspective, it's a way to extend their influence and create a yuan-based economic sphere. The total Belt and Road Initiative involvement now includes over 150 countries and international organizations. The total investment is estimated to be over $1 trillion, though the exact figure is hard to pin down because China doesn't publish comprehensive data. What's clear is that this is the most ambitious infrastructure project in human history, dwarfing even the Marshall Plan that rebuilt Europe after World War II. China has also been working on digital currency technology that could revolutionize how international trade works. The digital yuan, also called eCNY or DCP, is one of the most advanced central bank digital currencies in the world. China has been testing it domestically for several years, with pilot programs in major cities like Shenzhen, Shanghai, and Beijing. They're now starting to pilot it for international transactions, including with countries like Thailand, the UAE, and Hong Kong. The digital yuan gives China some powerful advantages. First, it allows the government to track every transaction in real time, which is useful for both tax collection and social control. Second, it eliminates the need for traditional banking infrastructure for international transactions. Third, and most importantly, it could allow countries to bypass the dollar-based SWIFT system entirely. Imagine a future where a Brazilian company wants to buy electronics from a Chinese manufacturer. Instead of converting Brazilian reals to dollars, then dollars to yuan, involving multiple banks and fees and days of processing time, they could simply transfer digital yuan directly in seconds. If that digital yuan is backed by gold, suddenly you have a fast, efficient, trustworthy alternative to the dollar system. That's the future China is building. The SWIFT system is worth understanding in more detail because it's one of America's most powerful geopolitical tools. SWIFT stands for Society for Worldwide Interbank Financial Telecommunication, and it's the network that banks around the world use to send money to each other. Founded in 1973, SWIFT now connects over 11,000 financial institutions in more than 200 countries. If you want to send money from a bank in Germany to a bank in Japan, it goes through SWIFT. The U.S. has enormous influence over SWIFT because so many transactions involve dollars and American banks, and because SWIFT's infrastructure and governance include significant Western control. This influence has allowed the U.S. to impose devastating sanctions on countries it wants to pressure. When the U.S. sanctioned Iran starting in 2012, it cut Iranian banks off from SWIFT, making it almost impossible for Iran to conduct international trade. Iran's oil exports plummeted from 2.5 million barrels per day to around 1 million barrels per day. The Iranian economy contracted sharply, and the currency lost 2/3 of its value. The sanctions were economically devastating. When the U.S. sanctioned Russia after the invasion of Ukraine in February 2022, it cut major Russian banks off from SWIFT, crippling Russia's ability to export goods and receive payment. The ruble initially crashed, and Russian international trade was severely disrupted. However, and this is important, Russia found workarounds. They increased trade with China, India, and other countries willing to use alternative payment systems. They demanded payment in rubles for energy exports to Europe. They accelerated their use of China's CIPS system. The Russia sanctions demonstrated both the power and the limitations of SWIFT as a weapon. Yes, it causes enormous disruption and economic pain. But it also accelerates the creation of alternative systems and motivates countries to reduce their dependence on Western financial infrastructure. Every time the U.S. weaponizes SWIFT, it gives countries more incentive to build alternatives. China has been watching these sanctions and learning. They've been developing alternatives to SWIFT, like the Cross-Border Interbank Payment System, or CIPS. Launched in 2015, CIPS was initially quite limited, but it's grown rapidly. By 2024, CIPS had over 1,300 direct participants and indirect participants in over 100 countries. It processes transactions worth trillions of yuan annually, though this is still a fraction of SWIFT's volume. Combined with the digital yuan and gold-backed settlements, China is building a parallel financial system that could allow countries to trade without depending on American infrastructure. The system isn't complete yet, and it's not as comprehensive or widely used as the dollar system, but it's growing every year. And every time the U.S. uses sanctions, more countries look at CIPS and think, maybe we need a backup plan. Now let's address some sophisticated economic dynamics that most people don't understand, but that are crucial to this story. When we talk about reserve currencies, we're really talking about what economists call network effects. A reserve currency is valuable because other people use it. The more people who use the dollar for trade, hold dollars as reserves, and price commodities in dollars, the more useful the dollar becomes to everyone else. This creates a powerful self-reinforcing cycle. Breaking this cycle is incredibly difficult. It's not enough for China to say, use the yuan instead. They have to offer compelling reasons for countries to switch, and they have to overcome the massive inertia of existing dollar infrastructure. This is why gold is so important to China's strategy. Gold offers something that breaks through the network effect problem, intrinsic value that doesn't depend on any government or network. Throughout history, gold has been the one form of money that transcends national borders and political systems. Ancient Rome used gold. Medieval Europe used gold. The Aztecs and Incas valued gold. Modern central banks hold gold. This universal acceptance is what makes gold uniquely powerful as a basis for a new currency system. If China says the yuan is backed by gold, they're tapping into thousands of years of human psychology and economic history. Let's talk about the concept of Triffin's dilemma, which is critical to understanding the dollar's vulnerability. In 1960, economist Robert Triffin identified a fundamental contradiction in having a national currency serve as the world's reserve currency. For the dollar to serve as a global reserve currency, the U.S. has to run persistent trade deficits, sending dollars out into the world so that other countries can hold them. But running persistent trade deficits undermines confidence in the currency's long-term value. This is the trap the U.S. finds itself in. To maintain the dollar's role as reserve currency, America has to keep running trade deficits, importing more than it exports, and sending dollars overseas. But these persistent deficits mean the U.S. is constantly going deeper into debt, which eventually undermines confidence in the dollar. It's a contradiction with no good solution within the existing system. China doesn't face Triffin's dilemma in the same way because they're not proposing the yuan as a pure fiat currency reserve. By backing the yuan with gold, at least partially, they sidestep the fundamental contradiction. Countries can hold yuan without worrying about persistent Chinese trade deficits undermining the currency's value, because the value is ultimately backed by gold, not just by China's economic performance. Let's examine the role of other countries in this equation more deeply, because this isn't just a two-player game between the U.S. and China. What other major economies do will significantly influence how this plays out. Europe, for instance, has been trying to maintain some independence from both the U.S. and China. The euro is the second most used reserve currency after the dollar, accounting for about 20% of global reserves compared to the dollar's roughly 60%. Europe has been pushing for more international trade to be conducted in euros. The European Union has been working on creating SPVs or special purpose vehicles to allow trade with sanctioned countries like Iran without using the dollar. They've also been advocating for euro-denominated energy contracts to reduce dependence on the petrodollar system. A weaker dollar could actually benefit the euro if Europe plays its cards right, potentially increasing the euro's share of global reserves and international trade. However, Europe faces its own challenges. The Eurozone has struggled with internal cohesion, as we saw during the Greek debt crisis and other problems. Not all EU members use the euro, and there are persistent tensions between Northern European countries like Germany and Southern European countries like Italy and Greece over fiscal policy. Europe also lacks the military power to project influence globally the way the US and increasingly China can. This limits the euro's potential as a reserve currency challenger. Russia, as we've mentioned, has been forced into closer economic ties with China due to Western sanctions. Russia has massive natural resources, particularly oil, gas, gold, and other minerals that China desperately needs for its economy. Russia produces about 10 million barrels of oil per day, making it one of the world's largest oil producers. It's also the world's largest exporter of natural gas. Russia has enormous reserves of coal, iron, nickel, palladium, and other strategic minerals. The Russia-China partnership, driven by their mutual opposition to American dominance, could form the core of an alternative economic bloc. Trade between Russia and China hit a record $240 billion in 2023 and continues to grow. Almost all of this trade is now conducted in yuan and rubles, bypassing the dollar entirely. Russia has been one of the most aggressive buyers of gold among major nations, and their gold reserves now exceed 2,000 tons, most of which was accumulated in the last 15 years. What makes the Russia-China partnership particularly significant is that it combines China's manufacturing might with Russia's natural resources. This is a potentially powerful economic foundation. Russia gets access to Chinese goods, technology, and financing. China gets secure supplies of the energy and raw materials it needs. Together, they can create a fairly self-sufficient economic bloc that doesn't need the dollar for internal trade. India presents an interesting and complex case. India is both a strategic partner of the U.S., particularly in containing China, and a major trading partner with China. India-China trade exceeds $100 billion annually, despite political tensions and border disputes. India has also been buying significant amounts of gold, both at the government level and among private citizens. Indians are culturally disposed to value gold, and India is consistently one of the world's largest gold consumers. India has been experimenting with settling some trade in rupees rather than dollars. They've pushed oil suppliers like Russia and the UAE to accept payment in rupees. India has also been developing its own digital currency, the digital rupee, which has been in pilot programs. India doesn't want to be dependent on either the US or China, so they're trying to create their own sphere of influence and maintain strategic autonomy. How India navigates the dollar-yuan competition could be crucial, given that India is on track to become the world's third largest economy, potentially surpassing Japan and Germany in the next few years. India's population of over 1.4 billion people, its growing middle class, and its strength in services and technology give it significant economic weight. If India sides more with China economically while maintaining security ties with the U.S., it complicates the geopolitical picture considerably. The BRICS group, which originally included Brazil, Russia, India, China, and South Africa, has expanded and is increasingly important to this story. In 2023, BRICS invited Saudi Arabia, Iran, Egypt, Ethiopia, and the UAE to join, though not all have formally completed the accession process. BRICS now represents over 40% of the world's population and over 30% of global GDP. The group has been discussing creating a BRICS currency, or at least a common payment system, to reduce dollar dependence. At the 2023 BRICS Summit, there was extensive discussion about alternatives to the dollar. While they didn't announce a BRICS currency, they did agree to promote trade in local currencies and to study the feasibility of a common currency. The fact that this discussion is happening at the highest levels shows how seriously these countries take the challenge of dollar dominance. If BRICS were to create a gold-backed common currency, it would be a game changer. The Middle East is perhaps the most critical region in this whole equation. The petrodollar system, where oil is sold in dollars, has been a cornerstone of dollar dominance since the 1970s. The arrangement between the U.S. and Saudi Arabia, formalized after the 1973 oil crisis, has been simple. Saudi Arabia sells oil in dollars and recycles petrodollars into U.S. Treasury bonds and weapons purchases. In return, the U.S. provides military protection to the Saudi regime and supports its regional interests. This system has been incredibly stable for 50 years, making the petrodollar one of the pillars of American financial power. Saudi Arabia, as the world's largest oil exporter and the leader of OPEC, essentially enforced dollar pricing for oil globally. Other oil producers followed Saudi Arabia's lead. As long as oil is priced in dollars, every country needs to hold dollars, which maintains demand for the dollar and allows the U.S. to print money without facing immediate consequences. But relationships are shifting. China is now the largest customer for Middle Eastern oil. China imports over 10 million barrels of oil per day, and much of that comes from Saudi Arabia, the UAE, Iraq, and other Middle Eastern producers. China is simply more important to Middle Eastern economies than the U.S. is at this point.